Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today we're going to talk about the income producing side of our portfolios, and joining me is Nick Leach, the PM responsible for this. Welcome, Nick.
Hi, Mike. Good to be here.
Nice to have you. Obviously, tariffs are top of mind, and even in income producing, any observations, anything coming out of, let's say, south of the border from the Fed, any pontificating in terms of what may happen?
It's definitely introduced a new source of volatility in the bond market. It's all because of the uncertainty. And in that respect, it's no different than what we're seeing in the equity markets and the currency markets. But if you look at what the Bank of Canada is saying in its last monetary report, they did refer to the tariffs and the possible trade dispute. And what they said was it's impossible to predict the scope and duration of a trade dispute. So they're not even going to attempt to incorporate any of that into their monetary forecast in the report that they just released. So that's the Bank of Canada. And the Federal Reserve is basically the same thing. Jerome Powell was testifying before Congress last week, and he was pressed on the tariffs and their impact. And he consistently said he cannot predict the outcome. He has no data, and he's not going to speculate what the outcome would be. And I would echo that. I'm in the same boat. Right. We don't have a precedent that we can look at to say, hey, what was it like the last time we had a trade war with our largest traded partner? It hasn't happened. So you just can't predict the outcome.
Makes sense. So let's talk about interest rates then from a Bank of Canada perspective. What have we been seeing? Well,
the Bank of Canada, they just had their last meeting at the end of January, and they lowered rates again. So that's the sixth consecutive time that they lowered rates. That's actually in contrast to the U.S. The Federal Reserve. Mm-hmm. They had their announcement right around the same time, end of January, and they paused. They didn't want to lower rates again. So now you've got this about 150 basis point differential between the policy rate in Canada, which is 150 basis points lower than the U.S. And that's one of the reasons why you've seen this weakness in the Canadian dollar over the past several months as well.
Well, and I was just going to go there because obviously the Bank of Canada, correct me if I'm wrong, the main policy here is to try and control inflation. Well, yeah. And I guess that it's still directly coupled to pending imports from the U.S. If our Canadian dollar starts to drop too much, they might have to.
Yeah, they're going to have to. Yeah, absolutely.
Raise rates. Yeah.
Yeah. That's always going to be a factor. If the dollar gets too low, our imports become more expensive, and that does cause inflation. But we haven't seen that yet.
Okay. So you talked about south of the border, inflation seems to be a little bit more stubborn there, and so
yeah. So if you look at the in the inflation in the U.S., it's about 100 basis points above their target, whereas in Canada we're just below the target. So yeah, the inflation in the U.S. has been kind of stubborn, mm-hmm. And that's why you have this 150 basis points differential in their policy rates.
Right.
Also, Mike, sorry, it's not just inflation because they do have a dual mandate, right? Inflation and employment. And if you look at the employment in Canada has moved up at a faster pace than the U.S., right? So it's at 6.6% today, and that's about 150 basis points higher than it was back in 2023. Whereas in the U.S., it's at 4%. That's only increased by 50 basis points. So you do have that employment picture as well, having that influencing the lower policy rates in Canada versus the U.S.
So from a yields perspective, what are we seeing?
So despite these differences that we're seeing in inflation and employment and the policy rates, the medium to longer term bond market is still being, and it always has been, influenced by moves in the U.S. And if we look at last week, what happened last week, is a good example. So you had the inflation rate in U.S. CPI came much hotter than expected. And so that caused a jump in the U.S. Treasury yield by about just over 10 basis points, which is a sizable move. But then despite no economic news out of Canada, the Canadian 10-year yield also jumped by 8 to 10 basis points. So now, like if you look at over the longer term period, that was just one day. But if you go, if the U.S. yield, 10-year yield, which is, the bellwether, we always look at the 10-year, that's around 100 basis points higher than it was, back in September, right?
Okay.
And then, but the Canadian 10-year is 40 basis points higher than it was back in September. But that's despite the Bank of Canada lowering rates by, like, as I said, 6 times in a row. So you have the short end coming down, but the longer end is kind of influenced and driven by what's happening in the U.S. market as well.
So in terms of the curve, the shape of the curve, would you say it's more flattening, or in fact it's now going back where it should be naturally rising?
Well, it is upward sloping,
okay.
But it's a very slightly upward sloping. So, and when we look at the yield curve, we often refer to the 2s versus the 10s, the 2 years versus the 10-year yields. And in Canada, the differential is 40 basis points. So it doesn't seem like much, does it? Like between 2-year and a 10-year, only 40 basis points. So that is relatively flat based on historical standards. And then the U.S., it's also upward sloping. I think the 2-year is around 4.25 and the 10-year is around 4.5. So you've only got about a 25 basis point slope there. Yes, but it's no longer inverted. I think what's interesting is when we talk about the yield curves were inverted in both Canada and the US for such an extended period of time, right? And you had all these economists looking at that, pointing it to it and saying, this is a sign of an imminent recession. We're going to have a recession. And that never happened. Like what's the old saying? Economists have predicted 10 out of the last 5 recessions.
Yeah, exactly. Yeah. Okay, let's talk about corporate versus government yields and the spreads.
Yeah.
What are we seeing there?
Well, the spreads are in Canada and the US, they're still very tight. Average spreads in Canada now are around 90 basis points. I think historically they're closer to 125 to 145. We did hit near historical lows a few months ago, and we're just up above that. But in the U.S., we're pretty close to historical lows, around 75 basis points in investment grade. U.S. high yield also very, very tight levels, near historical lows. I think what's interesting there is we talked about these tariff headlines, these trade war headlines have create a lot of volatility in the rates market, in the currency market, the equity market, but we haven't seen that in the credit markets yet. The credit market seems to be unfazed by any potential trade war.
So let's turn to pref shares. What are we seeing on the pref side of things?
Well, we could continue to see a lot of strength in that market. The total returns up 10% in the last 6 months, 20% over the last year. That's a total return. That includes around a 5 to 6% dividend. But what I think is notable here is it's dominated by these 5-year resets, right? Every 5 years over the 5-year Canada bond yield. And 5 years ago was the onset of COVID, right? So the 5-year Canada bond yield 5 years ago was less than 0.5%. So all those prefs that reset 5 years ago are up for renewal today or the next few months. So they're going to be resetting at substantially higher rates, right? Because the 5 years now at around 3%. And that's if they don't get redeemed.
Right.
The issuer has the option to redeem them. And if they do redeem them, that means lower supply, and lower supply is also pretty supportive for prices.
Right up the price. Okay. So looking forward, any adjustments? Are we making any adjustments, Nick, given obviously a lot of uncertainty, but any adjustments being made?
Well, we are gradually increasing our government bond exposure.
Okay.
And that really serves two purposes. First, it is an alternative for the preferred shares. As I just said, that market is shrinking and shrinking and shrinking. So, it's a good alternative for the preferred shares. And then secondly, it also provides some diversification against credit spread volatility, right? So whenever there's a significant sell-off in the equity markets, that usually coincides with a sell-off in corporates with spread widening and with preferreds. And in those times, government bonds tend to outperform, especially when there's really a high level of volatility. And that's because there's a flight to quality. So I think adding that government bond exposure should have the effect of lowering the overall volatility for any fixed income portfolio.
Okay.
But again, it's a gradual shift. It's not overnight.
Right. Okay, Nick. Well, thank you so much for this.
Oh, pleasure.
Folks, as always, if you have any questions, don't hesitate to reach out to your financial advisor at your accounting firm. Talk to your TriCert Investment Counsel portfolio manager, or don't hesitate to reach out to myself. Take care.